Fun show. I'm Niraj Shah. In the next 20 minutes, we'll try and talk about 2 or 3 critical aspects for mutual funds. Well, today's show is simple. I have asked both my guests to try and tell us what is the most balanced way, a risk-adjusted way, but which doesn't compromise too much on returns. So what is the best way to build a corpus of 1 crore rupees over a period of 5 years? What would it take for you to be sitting on 1 crore rupees at the end of 5 years from now? And what is the best composition of different mutual funds in order to reach that? So that's pretty critical. I'm looking forward to that as well. So that is part one. We also asked both our guests about whether the reopening of the Parag Parekh PPFAS mutual fund SIPs that they're restarted to take, is it a good idea to restart those SIPs if you had them or if you want to have them? That is part two. It's one of the better performing funds over the last 3 or 5 years, and therefore it comes up in conversation. Lastly, so many wrote to us about a very basic difference of what is an index fund versus a Nifty fund versus an ETF, and what does it take to have either. So we thought, and what is a better product if there is difference between the two? So we'll try and ask our experts that as well. And our experts today on the show, Prableen Bajpai, founder of FinFix Research and Analytics. She's been on the show enough. And Amit Kukreja, for the first time joining us on the show, he's founder of AmitKukreja.com. Both of you, thank you so much for joining in. Prableen, I'll start off with you first. Give us a sense of what would it take for an investor to build a corpus of 5 crores in the most balanced way possible in the current circumstances.
Right. Hi, Niraj. Great to be here. So I think whenever we are looking at building a corpus, you have given us a time factor that 5 years is the time factor. Now, what is important is what are your return expectations from the products which are picked, and the risk appetite of the investor. Somebody may be comfortable with a 6 to 7% return. That's all. Someone may be a high risk taker and is okay with taking, all equity exposure. So broadly, it would depend on what is the risk appetite and what is the comfort level of the investor. And on the basis of that, we can create a portfolio. So I have actually shared a table with you, which says that, if somebody is looking at a low risk sort of a portfolio, so just about 6 to 7% returns, it would be broadly a all debt portfolio for that person. And such a portfolio would actually require a very huge amount in terms of lump sum, let's say about 70 odd lakhs in the present date, oblique about 1.4 lakhs as SIP. And as you go higher the curve in terms of increasing your risk appetite, the demand in terms of what needs to be invested starts to go down because you're taking a high risk and your expected returns are going up. So broadly, the categories which I feel can be combined together, can be used in a certain permutation combination by investors based on whatever suitable risk appetite is. One is the debt basket. And there I have 3 funds which are all index and passive strategies within the debt segment. And I think, Neeraj, this is a very good time to take exposure to a 5-year sort of an index fund in the debt space, one that we are in the month of March. So it covers about 6 financial years. So indexation benefit would be higher. There is no credit risk in all of these, but yes, there would be interest rate risk. But all these 3 funds are target maturity. That means if you're holding them, so whatever yield they are entering at today, they get that, which is hovering around 6.2 to 6.5 between this percentage. So these 3 funds are IDFC Gilt Fund, Axis CRISIL, it is investing into the state loans. And the third one is the Edelweiss PSU Bond and SDL Index Fund. Now comes the second category, which is broadly hybrid. Now, how hybrid, as it is, gives you a combination of debt and equity. Now, here I have picked the conservative hybrid category for somebody who's only looking to take little exposure to equities, because it can go up to from 10 to about 25% in equities. Here, the 2 funds which I like are Kotak and Parag Parekh. Then one of the very popular categories, with a time frame of about 5 years, is the balanced advantage fund category, as well as the hybrid aggressive category. So from here, one fund from Edelweiss and Mirai is what I think that investors can look at. And these are not hardcore recommendations. These are just suggestions for investors to look at. These can give them decent returns. Edelweiss during March 2020 dip had only fallen by 13%, while the category funds had even fallen by about 32%. And even Mirai Asset has actually given no negative returns on a 5-year rolling basis. So this is the hybrid category. And Neeraj, now if somebody is again, let's say somebody parks a bit of their funds in debt, maybe something in hybrid or a conservative debt space, and wants to take some exposure to pure equities, some of the funds which I would suggest are the index fund, the large cap index. This can be done by a market weighted index, the regular Nifty 50, oblique equal weighted strategy like DSP has. And I'm suggesting DSP here because that is the oldest fund that we have in the equal Nifty space. Two active funds here, Axis FlexiCap and Parak FlexiCap. Again, these two funds have been consistent performers in terms of rolling return basis. And I think international allocation still makes a great case. And I think it's a good time to take some international exposure, maybe about 10%, 15%, depending on the risk appetite of the investor to go into global equities. And the options here can be the Kotak Nasdaq 100 or Aditya Birla Nasdaq 100. So combination of these funds, and based on that, you can work out the returns that they would get. If somebody is investing 20% in pure debt, 30% in a conservative fund, and 50% in an equity fund, with the range of returns that I have taken, they can get a portfolio returns of close to 10% with not a very high risk.
Okay, and therefore that would mean that their SIP sum needs to be about 1.25 lakh per month to reach the goal of 5 crores in about 1 crore in about 5 years.
Oh, yeah. That because it's a huge demand. 5 years is a very short time period.
Yeah, log jaldi mein hai, Prableen, kya kare? But yeah, okay. So I get this drift. So thank you. So, and Prableen, thanks. I was about to ask you about what percentages allocation that you would do. I'm glad you answered that, about 20, 30, and 50. And that would mean somewhere around 10% returns.
A 50-50 broadly approach, Niraj.
Yeah. 50% in pure equity and 50% in the remainder too. Perfect. Okay. Prableen, thanks for that. And a lot of options viewers, I think what Prableen is trying to follow is that she's not giving you the exact recos per se. She's giving you a range of funds and you can choose some of these. Now, keep in mind, just before I go to Amit, just keep in mind that the returns that maybe an ICICI Prudential Nifty Index fund would give would probably be slightly lower on a normalized basis than what a Parak FlexiCap or Axis FlexiCap would give. So you can pick and choose accordingly. A little bit of effort, viewer, you will have to put in as well when it comes to looking at the kind of recommendations that Prableen has given. Okay. Amit, I'll come to you and thank you so much for joining. It's the first time we have you on the MF show, so really good having you. What's your approach to this problem if somebody wants a crore in 5 years?
Sure. First of all, thank you, Niraj, for having me with you guys. It's wonderful to do my debut show with you. Thank you so much. I am slightly optimistic than Prableen, and I would not suggest a debt allocation through a mutual fund. I think, and I'll share the reasons, we have a very strong macro story. We seriously are gunning for a $5 trillion economy. And I don't see a reason why we won't be touching that in next 2 to 3 or 4 years time frame. Having said that, that can only be achieved by a strong economic engine, which means we have a tremendous growth story. So I would still stick with 100% equity fund allocation for this portfolio to accomplish a target of 1 crore in 5 years. I made some assumptions. Assumption number one, I do have the risk tolerance. And when I say I do have, I'm speaking on behalf of investors. So as an investor, I do have a risk tolerance, and I would keep my risk tolerance as a balanced risk profile. And my life stage is stable. I am not expecting any major disruption in my lifestyle in the next 5 to 6 years. So my life stage is stable. My risk profile is balanced. And age-wise also, I have a good enough life remaining, the professional working life remaining. So based on these 3 assumptions, and the fourth one, of course, is the macro assumption that we have a very powerful growth story, I would suggest an equity allocation through 5 schemes. And these schemes are low-cost index funds, which is UTI and HDFC. Both are index plans. So let's have that 20% each. And there is a 20% allocation that I'm suggesting, like Prableen, to Balance Advantage Fund, which has an algorithmic adjustment formula to debt and equity ratio, which is a hybrid fund. And they have a nice way of adjusting. So I don't want a manual effort of switching from equity to debt. I want to outsource that to my fund manager and let the fund manager handle that. but that's up to 30%. And the remaining 30%, I'm suggesting large and mid cap funds, of which 15% can be large and mid cap, and the other 15% can be the multi cap. Among the multi cap, I would suggest either one, SBI Focused or Parag Parikh Flexi. Among the large and mid cap, I would suggest either one, Canara Robeco or Access Growth Opportunities. In the Balance Advantage category, I would suggest either one, Kotak Balance Advantage or Edelweiss Balance Advantage. In the large cap space, I'm suggesting only index funds, which is UTNFE and 6 plan. 2-3 things I have to keep in mind, and I would recommend to the person who's seeking this advice. Behavior management is far more important than the portfolio management in the journey of an investor, which means if the market crashes, don't panic and don't try to exit your portfolio. I would also suggest that maintain the allocation of 20%, 20% large cap to index funds, 15%, 15% large and mid cap and multi-cap fund or a flexi cap fund, and 30% balance advantage. If you see there is an adjustment in the percentage exposure that we are trying to baseline or freeze is needed, then do that after a year or so. Because if the markets are crashing or if the mid cap space is going through any correction and the allocation has gone down, you might be better off moving a bit of money to capture that alpha. So assuming that 5-year horizon, assuming life stage is stable, assuming age is there, assuming professional life is there, assuming macro story is a very strong story, this is what my recommendation is. I would suggest an SIP of 1,30,000. You can do the breakup of the amount into these schemes based on the percentage that we have chosen, and continue to review the schemes. I might be absolutely wrong 18 months down the line or 24 months down the line. So fund manager, fund performance, alpha the fund is creating over the index, macro story. These are important parameters that need to be revisited on an annual basis.
Yeah, no, I think this morning on my trade setup, I had mentioned how the buy and hold need not necessarily work all the time. In fact, in a lot of cases, it's not worked. So the constant review is very, very necessary. Amit, just one quick follow-up. Do you reckon that having an all equity portfolio, though you do have a balance advantage fund, so therefore there is a small bit of debt allocation depending on what the fund manager chooses to do, but be that as it may, having an all equity portfolio is a balanced approach in the current times? You comfortable with that as being the balanced approach?
So that's a calculated risk I'm taking on the growth story of our country. So that's, as I said in the beginning, I'm more optimistic about the macro story of our economy. If you look at the corrections outside India, the corrections in the markets outside India are far more steeper than the correction in India. So, and if you look at the GDP story, we are still ranked number 6 in the top 10 GDP economies, right? So 6 is a good number. And we have a lot of scope. If we reach 5, we'll be in probably a 3rd or 4th after China and US, right? So I'm taking a call on that growth story, and hence I'm suggesting 12 months, 24 months down the line, if this changes, obviously we'll do the correction. But as of now, I would still gun for it.
Well, viewers, come to think of it, the one big takeaway for me from both of our experts' opinion, and mind you, please review. I think it's the right advice given by both of them. But the one thing that comes out is that a number between 1.2 to 1.3 or 1.35 per month as an SIP is probably that sweet spot. Now, it could be a bit here, a bit there. Some funds could do much better, and therefore the number might be lesser. I mean, and we hope all the funds do better. So therefore, you make a corpus which is even bigger than 1 crore. But largely speaking, 1.2 to 1.35 per month should largely do the trick for you if you follow what has been advised today, and if you, of course, periodically review and talk to a financial advisor for this review as well, unless you believe you have the time and the dedication to do it yourself. But anyways, so to both of you, thank you so much for this very important piece of advice. Prableen, sorry, did you want to say something?
No, nothing.
Okay, I thought you wanted to. Okay, so this is great. We now know the trick to making a crore in a safe, a slightly risk-free environment or risk-free method, so to say. Not equities are not reward or risk, by the way. But both of them mentioned about one particular fund, which is the PPFS Flexi Cap. Unless I'm wrong, both of them recommended that. Yeah. And I want to ask both of them this particular thing about, now that they've reopened for subscription, is PPFS a good scheme for people to start subscribing to again? Prableen, I'll come to you first on that.
Yeah, Neeraj, it definitely still remains a very good fund. I think there are 2, 3 changes which we have to look out for. Number one, that a lot of people have been investing in this fund thinking that, about 30% of their allocation is going into global equities. So they need not buy an international fund separately. And going forward, let's say if the limits are not enhanced, and even if limits are enhanced, but the AMC level limit retains at 1 billion, which is currently at 1 billion per AMC, they have already exhausted about 700 million. So the room for them to invest abroad, if the individual AMC limit is not increased, remains less, which is about 2,000 crores in Indian rupees. So dependence on this fund as to take exposure outside India, I think that is something investors should not do anymore. Secondly, of course, if the AUM grows substantially, then only the allocations to the current investments abroad, sort of start to change, which is currently about 30%. So obviously, if the AUM, let's say, increases or doubles up, the allocations would go down. But any new investors would also get exposure to that part of the portfolio because the NAV is calculated cumulatively. One thing which investors need to watch out for is that currently about 85% is invested in large caps, and that large caps includes these big technology giants outside. Now, if that allocation is not taken, will they increase their mid-cap allocation or will they increase their Indian large cap allocation? I think that needs to be checked. And otherwise, I think, Neeraj, we again have to give them time to, continue with the good work they've done earlier. And I don't see any change as to why investors should stop or redeem or not invest in the fund as of now. I think it's been a very well-managed fund and they should hopefully continue with it.
Amit, do your thoughts differ?
No, I agree with her. I think the fund management has been outstanding. The fund performance has been outstanding. They have definitely leveraged the growth cycle in the technology stocks outside India and the growth economy outside India. Overall, a good fund, and I still recommend that fund to be added to a portfolio. We need to watch for how the overseas economies are doing with respect to India. And if they are choosing at the moment to invest in Indian equities until the limits are revised, that's also not a bad call. I think it's a good call that they have reopened it yesterday, and it still goes as a highly recommended fund.
I mean, just quick follow-up. Somebody might be wondering. So therefore, this would be very basic question, but this would be open to anybody who wants to make an investment. If somebody didn't have a previous exposure to PPFS, doesn't stop that person from making that fresh investment, right?
That is correct.
Perfect. Okay. So viewers, here's the deal. I think a lot of people who wrote to us, and not a lot of people, some people of the people who write to us mentioned about why is it that PPFS is not, allowing them to invest because they had some prior investments. Some of them didn't have an investment and wanted to. I think here's your chance. If you believe that the past performance can be repeated, or if not repeated, it can be done in a good way, then yeah, maybe this is the chance for you to invest into PPFAS. Okay. The last question really is something that even people in my office asked me, and I thought it's best to address it on the show because I'm sure people outside also have this query, which is what is the difference between a Nifty ETF and an index fund? Which is better and why? Amit, I'll start this with you.
Sure. So index fund has ETF as its underlying asset. And sometimes there are index funds where the portfolio manager is managing the portfolio of the same stocks as the index. Generally, it's the ETF as the underlying asset. If you want to maintain your equity portfolio with ETF, you need a demat account. You will have to trade ETF the way you trade stocks. So you need a demat account. You pay the demat subscription fee. You pay the transaction fee for buying and selling ETF. But if you are subscribing to index fund, it's very much like a mutual fund. At the end of the day, there will be an NAV assigned to it, and that many units will be allocated to your PAN. Now, there is a bit of a tracking error, but that's okay. I mean, I don't I don't attribute a lot of performance falls due to tracking error. But in my opinion, given the simplicity and given the fact that I can set up an SIP calendar, given the fact that I can always keep index in my portfolio, I would go for an index fund as opposed to demat based ETF, because that just creates additional expenses, and your index fund may have an additional expense ratio as well. But for it's my preference, and I normally recommend my clients also, index fund is a better choice for me than an ETF.
The returns won't differ too much, right?
Not much.
Except for the tracking error.
Not much.
Okay.
Now, if you have a preference for another ETF, there are other ETFs also which are sectoral and thematic, then you can buy those ETFs. But if you are talking about plain vanilla index, Nifty 50 or Sensex 30, then go for an index fund. That's my view on this, and people can choose to do the ETF way as well.
Of course. Prableen, do you choose the ETF over the fund, or do you choose the fund over the ETF?
I think again depends, Niraj. I agree with the points which Amit has given. So broadly, an ETF is nothing but an index mutual fund which is tradable, and that is one advantage which index funds don't give. So there are investors who want to take advantage of the intraday dips, and I think that is one place where ETFs score over index funds, because index funds, you buy like a regular mutual fund, and at the end of the day. For investors, savvy investors, they can look at ETFs if they are looking to do those intra-trade orders, and also things like limit orders and all are allowed in an ETF. All these things are not possible in index funds. Also, in terms of expense ratios, index funds would range from about 0.08 to 0.21. That's about 5 funds that I took the average of. The range is about 0.08 to 0.21, and it's much cheaper in terms of an ETF. It's 0.05 to 0.12. So Niraj, for investors who have huge money, who are looking to make those calls and take advantage of those specific dips, there it I think makes sense to take an ETF exposure. Otherwise, I think for regular retail investors, for their SIPs, long-term investments, I think the index funds are equally suitable, and I think they can easily serve the purpose which they are meant for.
Probably a normal viewer, she would be wanting to know, are there specific kinds or index funds or ETFs that are largely recommended, or anyone is worth its salt?
So ETFs can be active and passive, both. Even in the US, about 20% of the ETFs are actively managed. So Niraj, first of all, when it's an ETF, they need to check whether it's an active or passive ETF. If it's away from the Nifty 50 that we are discussing. And even in terms of index funds, there are a lot of different beta strategies which have come in. So if you're talking about just the Nifty 50 or Sensex, it's easy for investors to do the comparison and invest. Otherwise, there are many different flavors offered by these two instruments, and then they really need to look a little deeper and then take a call.
Fair call. Just before we wrap up, actually, something that I missed asking, and just the final question to both of you. Probably to you first. This whole limit pause that is not unraveling, if you will, for mutual fund houses, which means that they can't really make fresh investments into overseas securities, or can't take monies from investors for those funds. What's happening here? I mean, are some fund houses allowed to do? Are some fund houses not doing it? Is there a indirect way? Because I read, and I think probably you told me about Navi trying to do this as well. What's happening here?
There are two baskets, Niraj. One is the 7 billion basket, where mutual funds are investing abroad, and there the underlying product is either through a brokerage account abroad that the mutual fund is managing, or through an active mutual fund abroad. So there is no use of ETFs there. ETFs domiciled abroad. It can be an Indian ETF. Okay, the one they have created in India. That's one basket where there is a capping now. There is a separate pool which is of $1 billion US dollars, wherein any mutual fund can invest abroad up to $1 billion overall as an industry limit, and up to 300 million per AMC, where the underlying ETF is an ETF domiciled abroad. So like iShares, Nasdaq fund, ETFs, and a few others we've seen. And here currently only 4 funds are existing, which are open for subscription. Kotak Nasdaq 100, ABSL Nasdaq 100, DSP Global Innovation, and the Navi US index, which is going to track the Vanguard ETF. Now here we know that Navi is going to launch a Nasdaq 100 FOF again because it will track an ETF abroad. And even Mirai has actually, filed for approval for 3 different ETFs abroad. One is artificial intelligence, one is for clean energy, and one is for cloud computing. And they will be investing in the Global X ETFs, which is another subsidiary of their parent, Mirai Global Investment Managers.
Okay.
So this limit, there is still scope. Currently, the industry limit of 12.8% has been utilized. So these 4 funds which are currently existing, they have taken up about 128 million as of now, the AUM. So there is still about, decent scope there for the industry. And I think that's how they are doing this.
Clearly, you invest a lot of your client money into those funds. Prableen, you have the numbers at the back of your hand.
No, but Niraj, I would definitely say that this, is very unfortunate. Capping has come at a very wrong time, but finally, actually, global markets are, seeing a correction. And this was actually a time to allocate a bit more. So unfortunate. So I think they should utilize the options available.
Yeah, but I doubt that the central bank works at the mercy of the valuations. Really, they would take a call depending on the other macros. But Amit, final words on this subject from your end as well.
No, I hope that the limits are revised sooner. I hope that Indians feel the flexibility to invest overseas. And the choices that Prableen was talking about, I think it's a good choice to have in the country now that we are gunning for the top 5 economies in the world. It just makes us more investor friendly. It makes us more flexible and in deploying our money outside India. So just hoping for the best. The limits are being revised soon.
Great. Well, both of you, thank you so much for constructing a portfolio for our viewers and our readers. Of course, it will be a part of the story that we put out on Saturday and answering some of the other questions as well. Prableen, great having you again. Thanks for being a part of the show. And Amit, great having you for the first time. Look forward to have you more often.
Thank you, Niraj. Thank you.
And viewers, thanks for tuning in to this leg of the Mutual Fund Show.
Bye-bye.